Test 1, 2, 3. reducing the cost when we top up our fuel from 12% to 6% for the customer. And as well, we have the partnership with Hopper Ports and Canada Clean Fuels to develop this biofuel terminal. And it's going to give us the competitor advantage. We don't have competitors in the market sponsoring this as well. And why we're going to do this is we've already been partnering with them, which gives us the first to market advantage here. Our competitors are going to enter this space, but we're going to be here now. So if we look as well at more projects that are coming along, there's more terminals that are going to be entering the terminal space, such as the IMO Green Voyage 2050, Sustainable Sea Transport Initiative. And as well, we're looking at getting the grant of the Green Shipping Corridor Programme, the Clean Vessel Demonstration Stream of 22.5 million. This will really help us here with reducing the cost for the customers as well. And some of our competitors that we must keep an eye on, you can see here Algo, Central Corporation, Fendez, Mitsui, and one quote from the CEO of this company, CSL, we've moved past the testing phase and are running biodiesel as part of our business. It's clear the CEO wants to go this route. He wants to go towards the greener route. So that's what we're going to do. I'm going to pass you now on to Oisín to speak about the contract terms and how to compensate.
Yeah, so just a brief overview, a few quick words, but I'll actually go to Dylan's partnership first and talk about the kind of contracts there, and perhaps how we're kind of mitigating risk by going with that kind of decision. The way, I'm sure all of you have been in some form or manner been involved in infrastructure, whether it be IT or buildings. There's obviously the daunting kind of upfront costs of these projects. But in terms of the terminal, the benefit here is that we don't have to front all of that because we're risk sharing. And our risk sharing idea is that we're committing to pre-purchase agreements for the biofuel oil. So rather than fronting cash, we're promising longer term return, longer term contracts for our fuel. So not only are we hedging our own costs, but we're also funding the project in a risk adverse manner. So if I go to the next one, please. So in terms of bridging that gap again, and rather than coming from the consumer side, what can we do for them? So I kind of have three proposals here in terms of the price and how we're going to bridge that gap and reduce down that circa 3% difference that we have between our competitors and ourselves due to the higher biofuel costs, right? Because in marine shipping, your rate is about approximately decided by 25% is the cost of the marine fuel. So because ours is higher, we need to bridge that about 3% gap. So I'll start with the bottom, really. There's an opportunity in the market now. If we start to lock in, we have an opportunity to raise our price, right? Brent crude, shipping markets, oil's at $83 a barrel. You're up, circa 30-40%. In the last 2 months alone. You have that ability to increase your price now with justification. So we'll bridge that gap. That's the first element of my idea. Second element is through Dylan's improvement in terms of capacity for the biofuels. Economies of scale will start kicking in eventually over the next 2 years when that project comes online, and we'll be able to bridge that gap without actually bumping up the price to our consumer. So by reducing the fuel costs. And then the third option, which I'll speak a little bit more in a minute, is the premium pricing. So this is the idea that because we're offering a lower carbon alternative, that we can boost, we can offer the company to pay for that premium, that gap, with validation again. So I might go to the next slide and explain that a little bit more for you guys. So the premium kind of idea is that we're bringing in other services that our firm offers, and in particular is our technology. So now, whilst the crane looks a bit old, it's actually improving in efficiency in terms of we have the automated cranes, and obviously we're building electric ships and that kind of thing, but that's not what we're really focusing on here. We're focusing on efficiency and what we can offer the customer. So 20% time efficiency and 30% cost efficiency. That drives that gap lower again for us to use. And some of the other kind of to justify that premium kind of pricing again is that verified reduction in your, actually I think a better word rather than reduction is savings. You know, rather than saying emissions, you know, you have your carbon savings, you know, you're making a difference, and the company can use that in their reports, going to their shareholders, going for the ESG, going to banks now. I know I worked in my bank for my placement, and you know, with all these ESG requirements coming in, it's great to see, but it's a lot of work if the company hasn't done it before. So having, you know, offering this complimentary service is fantastic. And then, of course, in terms of relationships, going to brokers and being able to certify that we're clean energy, we have better emissions targets is fantastic. Clarkson's is one of the biggest there, that just to name one we'd love to relationship with. Moving on then to the more granular kind of idea of what the contracts would be. So I kind of identified that there's a bit of a price differentiation between biofuels and the dirty marine diesel, as you might call it. Basically, biofuels are less volatile. So my idea is we have a dual contract offering to our customers. We're going to go for long dated contracts, obviously the benefits of that, locking in the customer, but also locking in the price now and getting that differentiation between the volatile dirty oil and the more stable biofuels. And then a little bit of a different tack is short dated contracts. What I look to offer here is offering short dated contracts, but because we have that volatility gap, we're able to offer the short dated contracts with long dated prices, and that's something the competitors don't do, and something that's very rare in the shipping markets and will really entice customers into our brand and to be able to pay that premium. So I think I'll pass over now to Ellen to look at how all that will work.
So this is just a brief kind of breakdown of kind of the highlights of our financials. So you can see in the top left, we've projected revenue nearly hitting around 630 million, and this is taking into consideration recouped value for both the firm and the customers as we change that pricing model with our biofuel premium reduction. Currently, the Canadian biofuel industry sits at a compound annual growth rate of 11.7%, and it is projected for the industry to grow to over 32 billion by 2030, which once again shows the massive area for growth for CSL to take advantage of and drive profitability long into the future. When we look at our projected revenue, as I said, this takes into consideration the green corridor negotiation we hope to take place with our biofuel provider, Canadian Clean Fuels. And this would be reducing it from a 12% premium to 6% for our customers, boosting revenue by 5 to 7% annually, kind of sitting at that 6% average over the next 5 years. And this is just a brief breakdown of our costs. So if you look just at these three boxes, this is really what kind of emphasizes it. So with our 12% premium over the $1,000 per MDO metric ton, we are saving the $120 premium we're currently paying on our biofuels and bringing this down to just $60, which is $60 savings for CSL per metric ton per customer fee. And this is annually, with our 3 million tons that are in circulation annually and deployed, it brings us to about $180 million in potential cost reduction compared to the full 12% market model. And this is just a brief breakdown of the green shipping corridor, which Kate brought us through, taking us through the dedicated priority vessel capacity, operational efficiency standards, measurable and verified emissions, as well as the deeper logistics integration, and kind of coming together with a price for 18 million, 7% of the firm's revenue. So taking out Kate for the risk mitigation.
Yeah, look, I think there's always risk integrating a new strategy in your company, but we've thought of these risks. So for example, there could be a risk of there being low customer demand here. We've mitigated that by increasing the benefits far above those of our competitors to ensure that this is not an issue. There's also, the issues of the economic landscape. Say, for example, with the US at the moment. This strategy we're implementing will result in 2028. And just to wrap this up, we are confident that this strategy will allow us to drive profitability and reduce costs over the next few years. Thank you for your attention, and we're happy to answer any questions you may have.
Right. Thank you. Thank you very much. The presentation is up. We will now begin the Q&A period. A friendly reminder, the Q&A will last for 10 minutes, and the timer will start whenever you're ready.
I'll start. One of the questions we've been having as a company is, are we making our case to the right people at our customers? What are your thoughts regarding that? Or are we making a mistake by going to the C-suite? Should we be talking to other people?
Yeah, I suppose like your customers are the guys who are going to be paying for it, and your customers aren't the C-suite in terms originally. When you're in shipping, when you're doing a contract, you're doing you have your buying line manager and you probably have your plant operator. The two guys looking to coordinate between each other. How much do we need? And he's looking like, well, I can pay this and get it for you. So that's where you kind of have to start. You can't, if you're going up to the CEO of every industrial company, it's going to take a massive amount of resources. I think, starting at the bottom, and the guys who actually know and understand what the impact is on price, because like what we're our strategies here are to bridging that gap, between the 3% extra over our competitors, bringing that back down to about half of that. So going to him and saying, well, actually, we're going to be reducing the cost in the future, and you can tell your bosses, by the way, that we're giving these benefits and the like. So I think an upstream approach is probably the best option there.
Next, thank you.
I don't have much.
Your presentation brought forward a partnership with.
Yep.
What would be the reasons to transact with this biofuel company?
Yeah,
what
so
benefit would they have in partnering with us?
Yeah, so currently we already have this partnership. So we have this partnership already, and this will be completed in 2030, right? And through this partnership, we'll be refueling here in this biofuel terminal, and we're also seeing more terminals being produced over the next 10 years also. If we go to this page as well, you can see it here, a list of the other terminals that are being produced, but there's no other competitors that are partnered with them. So we're looking at leveraging this. We're looking at utilising this partnership and really taking it a step forward.
So you already partnered with this biofuel company?
Yes.
In your presentation. Okay, great. Thank you.
Can you put slide 5, please? By the way, I like slide 7 because there's a takeaway at the bottom. So if you go back to slide 5, what's the takeaway on this slide?
Takeaway is that the customer is willing to engage, and we have to bridge that gap, I think, in terms of the price. One thing I didn't mention that's on the slide is actually Singapore and Rotterdam have seen about a 5-fold increase in the last 6 years in terms of people using the biofuel terminals there. But their price difference actually, is a much wider range, about 30%. So our price difference between marine diesel and the biofuel is about 12%. Whereas in Rotterdam and Singapore, it's about circa 30%, a little bit more sometimes. So to see that, there's almost a proof of concept that people are willing to engage. And with a lower price differentiation that we're looking at further lowering, if we can get our strategies in place here, that we'll see people engage with us.
So when you say engage,
Yeah.
pay more.
Yeah. And the idea then is that over time, with our strategies, with the terminal, using that kind of premium contract offering that we have, that we can bridge that gap and lower it.
Sure, good question. So I understand that we're able to bring the cost down from 12% to 6%. That's still an increase, and I understand we're trying to raise our prices for our consumers in the future. So what does that meeting look like when we go to our consumers or we're renegotiating our long-term contracts, when we're telling them that we need to increase our rates and so on? What's the main selling point that we're telling them to justify the increase in simple sentences?
When we approach them and we look at the partnership real quick, it is expensive. It is an expense, as we know, to go down this route. But when we go to them and we tell them we're going to enter this market, our competitors are going to see this and they're going to agree to it, because the competitors are going to then pivot towards the biofuel also. And it will then lead to more market share for the company as well.
And I think, when we're going into that meeting, so these kind of three elements will come up. First off is the price increase from inflation, say, and in terms of that, that's the price of oil going up right now. I mean, you see it the same with drinks. One drink company puts it up 10 cents, the next one puts it up 10 cents as well. So that's going to happen. Like, that is actually going to happen very soon. And so that will, cover, we'll say that's going to happen. And then we're going to go and say, well, listen, actually what we can do is offer you better contracts. Can we go to the next slide, please? Yeah. So then, like, our competitors don't have this ability to offer kind of long dated contracts or short dated contracts with that price integrity and that fuel security that we do because of the biofuels in terms of volatility gap, and because we're getting the economies of scale in the future coming from the terminal.
So you're talking about locking in a margin between biofuels and WTI or marine?
Yeah, but I mean,
marine
so the
oil?
idea with the short dated contracts is that margin will fluctuate,
Yeah.
but it'll always be positive in our favour. And the benefit of a short-term contract to a shipping owner is, in general, in terms of shipping rates, are about 20% higher for short-term rates rather than they are long-term rates.
Right.
So we can offer slightly better pricing in that regards because we have that kind of margin. And then the long-term ones, well, that's like any benefit of locking in a long-term customer. You're locking in your prices now, and we have the fuel prices will improve in our favour over time.
All right. The presupposition there is that biofuel
Mm-hmm.
is going to be, if oil shoots up,
Mhm.
biofuel will be cheaper
Lags.
than.
Yeah, lags, yeah.
So are you saying we set our shipping rates based on MDO, but we actually fill the ships with biofuel, so we're actually making money?
Yeah, but we're not gonna be greedy in terms of taking all that, because we still have that price differentiation. We need to knock it back a cut, but it kind of naturally hedges us to a degree.
But that also flips the equation, right? Because right now biofuel is
Mhm.
more expensive than MDO.
Yeah, so the way to think about that then is in terms of when the terminal comes online, our ships, the terminal has about a capacity of about 100 ships, right, in terms of refueling. Our shipping fleet of biofuel is only about 20% in the Great Lakes, 20% of that. So you've got an extra 80% margin that's still to be filled out there in the market, and that'll help us, give us a bit more leeway as well in terms of
Okay.
pricing.
Thank you.
As a customer, why would I pay a higher price for biofuel over and above that lock into a contract?
Yeah.
What is my incentive?
Yeah, so, well, I mean, apart from the good nature of your heart, which I'm sure counts for so much in business, well, depends. I mean, a lot of companies these days are coming under pressure. We know the customers are coming under pressure in terms of their climate targets and all this kind of stuff, right? So there's that offering, and there's probably no point in going into that, that little bit of waffling idea. But I think maybe one a little bit more concrete is getting the getting the relationship with the brokers as well. I mean, Clarkson's, for example, they kind of have a terminal set up, and that's where you do your shipping rates, like as a customer, and they promote shipping companies which have a better ESG score. So that physically comes up on your brokerage terminal. So there's that element for the customer, and then the idea is that we're offering kind of premium and complementary services alongside it to make up for the difference, in fairness, to make up for the difference in the price. And our automated cranery on the ships would be one of those offerings, which is the 30% cost reduction at the port, which gets transferred to the customer, and that 20% time difference, which is phenomenal in terms of industrial capacity.
And I think as well, just to add on to what Oisin had said, like there are new regulations coming in from the UN that are going to set to be in next year. They've already had paperwork in progress. This is stuff that our customers, whether they like it or not, are going to have to engage in and adapt to. And so we're providing them the opportunity to start now before all our competitors are and make it a competitive landscape. We're trying to be the first and bridge that gap for them so that they're not waiting until 2027 and everyone's doing it, but that they can do it now and be ahead of this curve.
I reckon there's about $330 million worth of carbon emissions taxes that will come in the North Great Lakes the next year when that IMO process comes into place. So fronting that now is a good idea for any customer.
All right. That's
you.
the end of our Q&A period. Thank you very much, delegates and judges, for your participation. I will ask everyone to leave the room so we can start preparing for the next presentation. Thank you.
I was giving an opportunity to the end.
and one of my degrees is from Concordia.
Hi, good morning. My name is Joanna Rosell. I am a portfolio manager and manage assets for a big bank in Canada. And I actually graduated for both my undergrad and graduate from Concordia. So, welcome.
Hello, Pat DiCivita, DiCivita Hobbiner, as a chartered professional accountant, and CPA, and also CIA. I also graduated from Concordia and also McGill University. Good luck in today's presentation.
Bonjour, Daniel Poliquin, retired from IBM, 16 years in organizational change management. Looking forward to your presentation. Thank you.
Good morning, Gabriel Persichino. I'm a manager of process transformation in a boutique consulting firm here, also a graduate of Concordia University. Welcome.
It is only when the last tree is cut, when the last river runs dry, when the last fish is fished, that people will realize that you cannot eat money. Now, your company has continued to be a leader within the shipping industry, working towards environmental change and sustainable practices. And you have the opportunity to continue this. You've worked beyond what regulatory constraints have demanded, and beyond what your competitors are currently doing now. And this is the perfect opportunity for you to continue working towards a cleaner, greener, safer, and smarter practices. Good afternoon, my name is Bella. I'm joined by my colleagues Bijan, Daisy, and Subon, and we are Atlas Consulting. Today we are tasked with the key question of how Canada's steamship lines can capture economic value from decarbonized logistics when customers value the outcome but are currently resisting paying for that. Well, we looked at 3 key tasks for you today. First of all, confirming if a greener offer is currently viable for your company. Identifying the value created for customers and for your company if you were to continue that green offer. And finally, evaluating those key implications to ensure success moving forward. Now, with our strategy getting on board, we're looking at a 2-pronged approach, first starting off with a pricing passage, looking at creating new pricing strategy for contract renewals and for new customers. Secondly, we'll be looking at our Green Guard, implementing an incentive program for a biofuel usage and greener initiatives moving forward. Now, this strategy is not only going to move your company forward, but we're going to see 2 key impacts here. First off, breaking even from your initiative of biofuel investments by 2031, and secondly, a 20% increase in carbon emissions being prevented moving forward. With that, we'll first start off with our analysis, where I'll pass it off to Subon.
Awesome, thanks Bella. As part of our initial analysis that we wanted to conduct, we wanted to look at the willingness to pay for actual cleaner transport across key industries. So we looked at a few key ones. The main ones that we understand that pass through the actual Great Lakes Basin and the St. Laurent Seaway, being basic materials, energy, and largely industrial goods. And what we ended up seeing is that materials, energy, and industrial goods all represent a high willingness to pay for cleaner transport. Secondly, the willingness to pay increases significantly when Scope 3 emissions reporting is included in terms of what the actual offering is. And lastly, growth opportunity for freight rate expansion, we believe exists based on the CSL's customer demographic, which is again highlighted on the left-hand side graph there. So the key takeaway here is that the shipping demographic through the Great Lakes region presents a high willingness to pay, but we wanted to take this a step further and ask why. To answer why, I'll pass it back to Bella.
Wonderful, thank you, Subon. So now looking a little bit at some strategic positioning for your company. First off, looking at those Great Basin exports. Well, currently 25% of those transports are going to international markets, as we're seeing, and 95% of them are large cargo commodities. Our key takeaway for this is that the Great Lakes Basin transport those large bulks commodities amounts to a diverse buyer base all over the globe. And what we're seeing from this is that those global environments are shifting towards stricter regulations. So starting off, we first looked at the Canadian Carbon Intensity Indicator, which is focusing on those requirements for reducing greenhouse gas emissions and reporting them further. Secondary, we looked at the EU's MRV regulation, which is requiring all individuals to monitor, report, and verify their CO2 emissions on a per voyage and annual basis. Our key takeaway for this is that there is a key demand for those green practices moving forward, with an increase for major import and export hubs today, transferring pressure onto those large companies moving forward to shift towards cleaner practices. Now, from this, we're also again being able to see that increased demand Again, looking at those cause of regulations pushing companies towards greener practices, but the effect of this is also that there's a large willingness for customers to pay for the Great Lakes Basin, and this will continue to allow them to remain elevated. So now is currently the time for your company and transporters alike to get ahead of the market that we're currently seeing and look towards utilizing that key demand for greener practices right now. Our key takeaway from this is that, again, now is the time for your organization to capitalize off of those consumer demands for greener practices while staying ahead of regulatory demands as we continue to see them shift.
Awesome, thanks Bella. Now we understand that something that you highlighted in the case was that regulatory practices are not enough to offset the actual increase in the costs that are occurring from the actual biofuel usage. And we note that currently biofuel commands about a 12% premium versus traditional maritime diesel oil. However, what we see moving forward is that the actual price is set to decrease based on several different economic indicators. The first one being that the cost of raw materials or the actual feedstock that's required to create the biofuels is set to decline. The second one being that increased production capacity is expected to come online as the actual demand for biofuel is expected to grow at a 10.5% compound annual growth rate into 2035. And lastly, economies of scale is set to emerge as biofuel market matures both in North America and internationally, which we believe will naturally create a scenario where the actual price of biofuels and the actual usage of MDOs in your current process will begin to converge, which we will highlight later as part of our impact. The key takeaway here being that a decrease in the biofuel cost over the next few years will make the price difference versus MDO tighter, supporting the overall margins and financial health of your organization.
Wonderful, thank you, Suvan. Now, before we get into the implementation, we have to know, is this a viable opportunity for you to continue those greener practices? Well, we looked at those 3 key challenges that you outlined in the case. First being the likeliness of genuine customer interest moving forward. Now, we were able to see that tangible demand through our first analysis tool, again being able to see that shipping demographic through the Great Lakes Basin and that high willingness to pay. Secondary, we looked at whether or not there's a clear value for your company and for your customers moving forward. With our situational analysis, again, we were able to see that now is the time for you to make that shift moving forward. And finally, we're able to conclude that if that greener offer is really viable for you right now, and with our final final analysis that Subhan walked you through, again, we're able to see that decrease in biofuel costs over the next few years, making now the perfect opportunity for you to continue with that greener offering.
Awesome. Thank you, Bella, for going over that summary of our analysis. And now we are extremely excited to talk to you about our strategy called Getting On Board. With our first prong being that pricing passage, and that second prong being the green guard, we are not only here to provide some idea for you, but we are here to take that the problem of today into the opportunity for tomorrow. And with that being said, we'll start off with the first prong. So what is our strategy here in its essence? Well, we are looking at increasing the price for the consumer while still creating that value. But what is the actual change? So we'll shift the price increase onto the consumer for new and renewed contracts starting in 2026. That price increase we'll look at an average of 5% with that biofuel usage, which we'll talk about a little bit more. So what is this value added actually? Well, for the consumer, there is a stricter global standards force companies to actually push for greener supply chains. Many use green shipping to actually differentiate themselves within their competitors. And for CSL, your company, the goal here is to maintain leadership within the markets within that low carbon shipping space. And our case study that we've used to actually help analyze and provide a strategy for you is the company Hapag Lloyd has actually started increasing prices in 2024 and has actually reported a very strong performance in the first half of 2025 despite disruptions within the industry. So taking a further look at what our analysis has built off of, we have noticed that 20% of front runners within consumers, or the customers, are not yet using carbon neutral shipping. I mean, many of them actually miss the knowledge on what sources and what services there are available to them. And we saw with this BCG study that there is a direct interest in the market, but the customers are not told about what the available products currently are.
Thank you so much, Bijan. Now, I would be so excited to tell you about our second prong for this, the green guard. So, going into a brief overview of what this is, it's going to be an incentive program. Now, we understand that you have asked us to create an idea and a solution for why you think we should be increasing our prices. You did mention that you were worried about increasing prices and how this may affect your relationships with your customers. This is why we've created an incentive plan to help motivate your customers, even though we have already shown you some analysis on their willingness to pay. The reasoning for this is that with this, we can make sure that we are now incentivizing those green practices. We are going to have more sustainable practices in the future, and this is how we are able to meet those CSR goals while also incentivizing those green initiatives with our customers. So we'll go into what value this adds for yourself and for your customers. For the customers, they are now more likely to engage with this price increase and continue to have good relations with us. Whereas for us, when we see this implementation had for your company, we see that you guys are now going to have better relations with your customers in those long-term contracts, and in the future we're going to have this price offset with our fuel, as we see with the economies of scale of our fuel prices going down. So an example of what this may look like, and I'll expand on this, is for every metric ton of biofuel used, a customer receives a 0.5 credit. We're going to create tiers so that we can gamify this, and we're going to have this program be used to increase customer engagement. So you may be wondering, what are the tiers and how do these affect the credits? So let me drive you through what our tiers would look like. So at minimum, we would like to use a 1:4 ratio for biofuel, making sure that there is no credit offered at this stage. We want to ensure that we are at least using biofuel in every single trip that we send out, because we want to make sure that we are hitting those sustainability goals. This will be the standard minimum required amount of biofuel used in every renewed contract and with new customers. Now, for our first incentive tier, with 25% to 50% biofuel used per project, per trip, where there is now going to be a minimal credit offered, with, again, the amount of biofuel used translating to a certain amount of credits. And then second incentive tier is going to be 50 to 75%, a now moderate amount of credit offered. And for our third incentive tier is going to be that 70 to 100% biofuel use, which is now going to be a more attractive credit. And finally, we would like to look at this as a future consideration of a bonus credit, where if you have customers who are continuously using 100% biofuel in their trips, we should be rewarding them for their sustainability efforts. Now, going further into this, what does this look like for the customer and what does it mean for you, CSL? So first, let's use example of customer X, a customer that you've been working with for a very long time. Their primary location is that they get cement sent to them over in Australia. So here's what we're going to be going through first, is that they will renew their contract with us within the next couple of years, and they're going to show us that they are going to want to engage with this because now they're seeing that they can have these incentives. So they've decided to use the 50% incentive program, which is our second tier, and they now receive incentive credits. Now, with that, if we assume that they've taken a 100% capacity, which is 30,000 metric tons per freight, and they're now using 50% biofuel for that trip, we are now seeing that we're going to see credits in relation to that ratio, which they can now store, and with, of course, some limitations, some exceptions, and time accreditation. They cannot keep those credits stored for forever. There is a time limit on when they can be used. We can see that they'll be able to apply those to future projects to get a discount on future projects. And as we see, they're going to have some exceptions. They can only use on certain projects. Some examples would be if it were a full cargo trip or if it were a minimum distance trip, to make sure that we're not cutting into our profit margin too much there, and only up to a certain percentage of the cost for this project. As an example, maybe 10% or even less, depending on, of course, we know that profit margins in this industry can be a little volatile, so we would make sure that we are realigning based on industry benchmarking. So now I'd like to pass it back to Bijan to give you a full summary of what we've just explained to you.
Awesome, thank you, Daisy. So today we talked to you about our strategy, which is negotiating contract terms on new and renewed contracts moving forward starting in 2026. Well, first of all, we wanted to look at the embedded premium pricing. So we want to include the average 5% increase starting in 2026 on any of those new and renewed contracts. Secondly, we want to see that non-cash credits, which is transferable to financial gratification and cash equivalent discounts down the road when companies continuously use the service and want to rebuild that they want to renew their contracts once they're done. But we know from any project that we have, any goals that we want to look forward to, that there is now a unique opportunity to implement this into markets. We have seen companies, like our case studies, we have seen companies do this before, but there still isn't a major shift into a lot of freight transportation, and in the marine space specifically, looking at these green renewable sources. But with our unique opportunity, the goal starts tomorrow. With starting tomorrow, they are to begin negotiations with new companies and companies looking to renew their contracts soon.
Great, thank you, Bijan. Now, we understand that one of the key tasks that you outlined for us is to evaluate the financial, the strategic, as well as the competitive benefit of what our solution is actually proposing. The first thing that we wanted to do, and I'd like to draw back to the earlier analysis that I mentioned on the actual decrease in the cost of biofuels moving forward, was to just conduct a quick financial break-even analysis. So what we did here was assuming some of the numbers that were provided to us in the case and looking at some market data on what the actual price for biofuels is like and what it's been improving year over year. Now, we were given the projection based off our research that typically anywhere from about 5 to 25% of a cost reduction in the price of biofuels is expected to occur between now and 2035. What we did was we took a haircut to the high end of that. We assumed that 15% would occur in our time frame that we analyzed, so about a 3% decrease year over year, which starting in 2027 ends up to us actually being able to break even where the price of using biofuels versus the price of using MDOs actually ends up being the same. And so we don't necessarily have to keep continuing charging customers premium because the price is now officially being the same as it was before. But what is the actual impact of this strategically? First ones, you get cost savings through the efficiency of being able to implement this. And second, there's an improved brand reputation. Again, having that first mover advantage, especially in the Great Lakes and St. Laurent Seaway, where this is not a very high volume practice currently. And second, the benefits competitively. The first one being that you stay competitive as a leader in low carbon shipping to customers across a diverse global brand. And lastly, allows access to increased green financing, such as the different carbon credits, as well as different grant programs that the government of Canada, as well as the government of the United States offer currently. Now, we know that with any key implementation idea, there comes risks and mitigations. And we've identified two key ones for your organization today. The first being a geopolitical shift that occurs that doesn't necessarily align with more greenhouse gas emissions reporting and things of that nature. And our mitigation for this is to maintain ahead of current regulatory demands, which we know your organization proactively does currently. The second one is minimum engagement with the incentive program that we are attempting to offer. And we want to realign the tiers with the demand of customers by making it a little bit more flexible. However, we believe that given the 5%, we are being conservative based on our initial analysis tool, where we saw that the key customers that your organization actually services have a high willingness to pay for these greener transport channels. And with that, we believe that mitigation strategies will help alleviate and bring the actual likelihood and the impact down of any of these risks.
So now, again, just to summarize our presentation today, we took a look at the 3 key challenges that were given to us within the case. First, we identified where the value is created for customers and the customers and for your company, CSL, which was from deriving demand, and we see an increase in their ownership of the green initiative. Secondly, we looked at the key mechanisms to ensure value is captured through the solution. So that came from providing incentives and highlighting through the premium pricing model and the non-cash credits on contract. And finally, the last key challenges that we were tasked with today was the key implication to ensure competitive and strategic goals, which was derived from creating guidelines and highlighting through the KPIs to ensure success throughout the project.
Wonderful, thank you, Bijan. Now, I know that we've thrown a lot at you today, so let me summarize it up really quickly for you. That first problem that we were really looking to solve today was how can your company, the Canadian Steamship Lines, capture economic value within the decarbonized logistics area by when customers are currently wanting and demanding that value, but they're not currently looking to pay the prices to be able to make that continuously viable. those key 3 tasks that we looked at today was the confirmation of a greener offer continuing to be viable for you, identifying the value not just for you but for your customers to incentivize them to be able to use that moving forward, and finally evaluating those key initiatives to continue this moving forward. Now with our strategy getting on board, looking at that 2-pronged approach, first the pricing passage and the green card, we were not only to meet the demands of your organization but focus on those 2 key impacts for you. First, the financial, being able to break even by 2031 and reduce the current financial burden that you're facing of your initiative moving forward. And second, that 20% increase in being able to capture and reduce carbon emissions. This is really something that was focused on your your environmental aspects of being able to move this forward and work towards more sustainable practices moving forward. Now, at the beginning, I mentioned what the world would currently be looking like if we continue to be looking at the world money-focused instead of environmentally focused. Your organization has continued to push forward to make sure that you are more sustainable in your practices, but making it viable for your customers. And now is the perfect time to continue this moving forward. Thank you so much, and we open the floor to any questions.
The presentation is now up. We will now begin the Q&A period. Friendly reminder, the Q&A period is only for 10 minutes, and I will start the timer whenever you're ready.
Thank you. Thank you very much for the presentation. Presume that we're the board of directors of the company. Who should we be selling the program to? Specifically, who should, in our firm, be spearheading this process, and who should those people be focusing on in our clients, many of whom are large multinational bulk commodity producers?
Absolutely. And just to clarify, you speak of our Green Guard incentive program, of course. So with this specifically, we would be talking to the people who are renegotiating those contract renewals. We have a lot of contracts that are coming up to date. We do medium to long-term contracts. We went and assumed 5 to 10 years with those medium to long-term contracts. And whenever those come into negotiation, the head of negotiations with those large multi-billion-dollar companies would be the person that we would be talking to with this incentive program. We would like to include it in our contracts, and we do think that it would be something that would be based upon project by project. So when we see that request for freight, we would be including the incentive program, and it would just be an added reward on top whenever they see the list of costs, and when they sign off on, yes, I'm willing to pay this much and I am willing to receive this many credits going forward.
I have a question. So you identified 3 industries that are showing a high willingness to accept a price increase. What is the percentage of the total business of the company that goes towards this 3 industries?
Yeah, that's a great question. And when we were conducting our analysis based on the information provided in the case, as well as secondary analysis that we saw by looking up what's actually transported through the Great Lakes Basin and the actual St. Laurent Seaway, we found that a large majority of it is, again, the commodities that were mentioned, but also industrial goods, as well as critical materials such as your steel, your iron ore, and things of that nature. For that reason, those are the 3 ones that we wanted to highlight to really understand what the actual willingness to pay of these customers is. And we find that because of stricter regulations, as well as more transparency being demanded from the actual investors within these companies with regards to greenhouse gas emissions, they represent a higher willingness to pay, especially when it comes to including the Scope 3 emissions, which is essentially the downstream portion of their business, by how they actually get the end product to customers.
And how much is of our business going towards energy, industrials, and basic materials?
That number we were trying to quantify as well online based on what it was. Well, the best that we could find based on public disclosures was that what the overall number of the actual St. Laurent Seaway was. Now, in the actual case itself, what it says was that the primary exports that they actually focus on is, again, part of either one of these 3 industries, largely the industrial goods and things like your bulk commodities as well as your agriculture.
So the other ones are minor clients?
Yes, yes.
Perfect. Thank you.
So as a customer, taking into account the incentives that are going to be offered, what is my actual savings in switching to your proposal of biofuels?
Absolutely. Well, not only will you be receiving now more carbon accreditation that you can claim for your company, because now you're able to say that yes, we are sourcing sustainably now. We are now those third sector of your sourcing for your materials is now going to be more sustainable. So not only will you be able to claim that, but you will also be able to claim that you're going to be seeing a, depending on the amount of sustainability that you'd like to trade off for, you'll now have a reduction in your price for future projects. So you can now claim that for later projects. So it depends on the trade-off that your company would prefer on the more sustainable sourcing versus the more financially sustainable.
Yeah, and might I add to that, again, part of the initial analysis that we conducted, we wanted to actually look at, again, not only the willingness to pay of customers, but what the actual reasoning behind the why ended up being. And so while they want to be more greenhouse friendly and want to align better with investor interests, the large majority of these large multinational companies presented, because they have a diverse investor base, we're now shifting towards a lot more stringent sort of emissions guidelines that they want to see moving forward. So while it might be a slight monetary increase in the actual transportation costs that you're paying for this, what it results in is a net overall socially responsible action that your organization takes. And we believe that the actual social rate of return on this project is a lot higher than the necessarily IRR that might be decreasing in the future.
Sorry, but as an accountant, I'm concerned with the bottom line. Can you quantify that? How much am I saving, percentage, dollar-wise?
Yeah, absolutely. So that specifically, we didn't know the exact amount. We don't have access to balance sheets. We don't have access to the exact amount that freight may cost. We don't know exactly how much your customers would want, whether they, when you're shipping cement to Australia, whether it's a full 30,000 metric tons of cargo, or if it's just half that. So it's a little bit difficult to quantify exactly, which is why we gave you a percentage of credits per metric tonnage of fuel used, and we base that off of your biofuel ships using around 100 to 150 metric tons of fuel per day. So it is difficult to give you an exact number on how much you'll be saving, how much it'll cost you, but we will say that it's going to be better long term because you'll have cheaper projects in the long term, and it's also going to be looking better for you on your CSR goals.
Can you go to slide 50, please? Help me juxtapose that sound barrier, 1%, like our customers, maritime transportation, it's only 1% of their cost, with demand. Like, what's driving demand if it's only 1%?
Yeah, I think the largest portion, again, that's actually driving demand is, again, in relations to corporations, especially the large multinationals that we know you partner with, wanting to increase, again, their social, corporate social responsibility and progressing those goals. Now, we also understand that a lot of the actual transportation that occurs is downstream, meaning that it ends up in markets outside of on the other side of the Atlantic, especially in areas like Europe. And so what ends up occurring is that investor appetite is now appealing towards better socially responsible organizations. And so again, when we conducted our willingness to pay analysis, we kept that in mind. We wanted to really understand actually why the companies want to do it, and it's not just regulation based, it's also based on the fact that investors are now beginning to demand higher returns. So while it is a lower portion of, as you mentioned, it's about 1% of the actual emissions, because it's still part of the downstream supply chain aspect of the organization's overall structure, they still want to see, again, those scope 3 GHG emissions, which we know your green initiative is willing to provide moving forward, which is why we think it's the most viable option for you to pursue.
As the biofuel costs go down, the barrier to entry will become smaller and smaller, therefore easier for competitors to copy us and mimic us, right? So with the credit program, how do we ensure, or will our competitors be able to just copy this program? How do we continue to stay past that when the barrier to entry is really kind of just the same for everybody? How do we continue to still differentiate ourselves past that point?
Absolutely, yes. So with that credit program right now, we're seeing it as an incentive because we are that pioneer in the industry, because we are the first. We're trying to see that a lot of our customers may be hesitant, they may be tentative willingness. So this is our incentive program to engage and make sure that we are guaranteed the integration with our new credit program. As we see more and more companies switch to biofuel, which is what our goal is, we do want more companies to be using it because that leads to economies of scale. It becomes cheaper for us, the less we will actually be needing to use those credit programs. And as we move forward, we can industry benchmark, we can realign. We may need to discontinue the program because we won't need it, because we will be continuously using solely biofuel and it will be normal operations.
Good answer, thank you.
Thank you.
We have time for one more question, about 1 minute left.
I have one question, it's gonna be fast. So you mentioned that the plan was an increase in prices by 5%, and then you kind of mentioned that there was going to be a decrease in biofuel cost. Is that increase in price temporary? Would that be a renegotiation? What is the projected timeline of the contracts that you would be negotiating at an increase of 5%? Can you develop
Absolutely.
that?
I will do my best to answer, and if we have time, he'll tag along. But with that, we say that as we've seen with previous increases due to perhaps the pandemic, even we've seen that there is willingness as prices increase, that you could just keep those prices going forwards. If we do see that our costs are going down significantly and we want to renegotiate our prices, we certainly can. If you have anything to say.
Yeah, I think the only last thing that I would add to that is the fact that, again, the 5% increase is, again, what we are hoping for ideally is to just offset the fact that we are incurring a significant loss by having converted most of your fleet to biofuels. As biofuels start to become more pungent in the industry and more looked favorably towards, we view that the 5 to 10 years down the line when you renegotiate the contracts, you won't necessarily even need to have a higher price point to incentivize users moving forward.
And that would go in line with the higher supply as well if there's lower barriers to enter for competitors.
Yes, ma'am. Thank you.
Right.
Okay.
That'll be the end of the Q&A period. Thank you so much, delegates and judges. It was a wonderful presentation. We will now ask all the audience members and the delegates to leave the room. And thank you very much.
Thank you.
Thank you.
Thank you very much. Appreciate it.
Thank you. Really appreciate it.
Thank you very much.
Thank you.
Merci beaucoup. Merci beaucoup. Thank you so much.
Thank you.
Great job.
tell who signed in? Go on. Hello. Nice to meet you.
Nice to meet
you.
you. Nice to meet you.
Hello.
All right, welcome everyone. Hello, my name is Arhana. I will be your timekeeper for today. And before we continue, I would just like to confirm this is Team C, correct?
Correct.
All right. I will show you warning signals when there is 10, 5, and 2 minutes, as well as 30 seconds remaining. Once the 10-second countdown is up, I will say stop, after which the team must stop talking immediately. Afterwards, a 10-minute Q&A will follow. And I would like to remind you that all teams must present in a minimum of 15 minutes, and all team members must speak during the presentation, but not necessarily during the Q&A period. Audience members, we ask you that you please place your phones on silent mode and remain seated in the room for the duration of the full presentation as well as the Q&A period. I will now let the judges introduce themselves, after which we will begin the presentation.
Hi guys, my name is Jim DiGiacomo. I'm retired, 37 years in banking, and one of my degrees is from Concordia.
Hi, my name is Joanna Marocel. I'm a portfolio manager. I manage assets for institutional clients, and I also graduated in Concordia.
Hello, Pat DiCivita from DiCivita Habenreiser, Chartered Professional Accountants. I'm a CPA and also CIA, and I also graduated from Concordia.
Hello, Daniel, retired from IBM. Thank you.
Good afternoon, Gabriel Persichino. I'm a manager of process transformation in a boutique consulting firm here in Montreal in the aviation sector. Also a graduate from Concordia University.
Perfect.
Sustainability is a key topic in today's supply chain industry. While CSL is at the forefront, there's always a risk to pay, either monetary or by risk. So the key question here today is how should we continue to share this risk with various partners in order to have a sustainable strategy in the long run? Well, we believe this is possible through our strategy today, Empower and Engage through the sustainability sector. Good morning, everyone. My name is Lisa. Together with Team C, Irene, Kelly, and Hazel, we'll be proposing a business proposal strategy today. Here's the key question we'll be diving into today's sector. How can CSL be compensated for delivering decarbonization when customer values the outcome but have low willingness to pay? So, along with this, there are two key sub-questions on if should CSL provide green offers to existing customers, and if how should CSL capture the value of decarbonization to their customers. Now, we believe this Empower and Engage strategy will provide an ultimate impact of offsetting biofuel margin erosion and achieve 7 million incremental revenue in the long run. So let us see where CSL stands today. Their company provides several key customers, which is for construction materials, raw industrial output, as well as agricultural shipping, which are ultimately price sensitive in the long run. They are also covering global trade routes, but have a major concentration on US and Canada hubs. And lastly, they operate through three key value propositions on reliability, capacity assurance, as well as competitive pricing. And they have various sustainability initiatives here today through the green strategic leadership, which ultimately leads to four strategies as well as initiatives currently. Firstly, is switching to biofuel, which although comes at a cost of 12% green premium versus marine biodiesel. Second is vessel upgrades, which they have 8 to 10 vessels which are upgraded to provide more efficient fuel usage. Thirdly, is providing emission monitoring system services, which is accommodating emission assurance. And lastly is constructing battery-powered self-unloading vessels, which is still on the way. So with this in mind, they have two key challenges, which is if they should provide green offers and how they can demonstrate value. So how can they compact this in the long run? So let us take a look at the sustainability landscape here today. Globally, we have this strategy and as well as regulation to classify the emissions into three ways, which is Scope 1 on direct company emissions, Scope 2 indirect emissions specifically for electricity, heating, and cooling, and lastly, indirect emissions for supply chain emissions, including transportation. And locally, the Canadian government has provided various sponsorships and initiatives in order to boost the sustainability initiatives from very company, including this green shipping corridor, which provides funding for testing green initiatives. And along with this landscape, we see two opportunities that CSL can capture today, which is due to the fact that CSL has large Scope 3 emissions for their customers, and secondly, that CSL can leverage this green shipping corridor benefits as well. Now that we know this, how can CSL incorporate these trends in order to provide a better business model for their clients? So we also know that today that CSL is looking to develop green commercial offers. And it is basically a business arrangement to provide and improve environmental performance and carbon footprint between various parties. So in order to know which and if they should develop these green commercial offers, we look at various common pricings and potential types of green offers, which is firstly, green pricing, which have a medium direct emission impact, medium potential revenue, as well as high potential of customer loss, which may not be suitable considering CSL's profile. We also take a look at the trend of Scope 3 offtake via book and claim system, as well as the development of digital and data-driven platforms, which are compatible with CSL's profile and what they're seeking for in the future. We believe by adopting these two strategies, it can provide value-add service for compliance and regulatory monitoring, high emission reduction, as well as less to none green premium paid by the customers, which are their major concerns. So we believe that these are the two ways that CSL can explore in the future. So this comes to our key question here today, on how CSL can be compensated for delivering decarbonization when customers value the outcome but have low willingness to pay. And we believe we can achieve this through our Empower and Engage strategy. Now let us move on, and let me pass my time to Irene to talk more about how we can empower sustainability.
Thank you, Lisa. So that we have a lot of situations that we are coming to. So that the first thing that I would like to introduce is actually to empower how we could tackle the green premium via the Scope 3 offtake agreement, which is how we would like to propose a new business model on how CSL firstly is going to do like the shipping decarbonization. We'll do all the green decarbonization. And secondly, we have the buyers here. Buyers here are actually companies which do a lot of emissions, which, for example, Microsoft itself, based on our research, they have 97% of their carbon emissions is from the Scope 3 initiatives. And with CSL doing this shipping decarbonization, we will have Scope 3 emissions credits. And by that, CSL could sell the emission credits towards the buyer, for example, Microsoft here. Then, in return, the buyer could provide CSL monetary benefits. Then, what's the monetary benefits for? So, second of all, we'll have the customers. The customer here is actually our current customer base, such as the agriculturals and also the manufacturers in the industry that has already been our target customers. Here, CSL will provide our customers, green fuels. So we'll provide them green initiatives, green decarbonization throughout their shipping journey. But in the same time, these customers won't pay the green pricing. This is because, as mentioned by Lisa, the willingness to pay for this green pricing is actually very low. And that is the reason why we won't ask our customers to utilize the green pricing strategy. But in the same time, so we would like to utilize the monetary benefits that we receive from the buyers to actually offset the green fuel pricing that we give to our customers, so that with this strategy, the green premium is offset. This strategy, if you think this strategy would be successful, yes, because we do think this is successful due to our case study of Cathay Pacific. Cathay Pacific have this Fly Greener initiatives, which is all about the sustainable aviation fuel, where the key pillars includes the transparency, carbon calculator, non-profit, and also the targeted impact. Several key statistics that I would like to mention today would be their target of 10% SAF by 2030, and also this cycle will reduce their 300,000 tons of carbon emissions. And in the same time, it's all reducing their carbon life cycle emissions by up to 80%.
And these initiatives would give an impact by having several non-profit impacts, such as the solar water heating in India or the other activities that they did in China. Then what if we come back again to this business strategy, then you might be thinking then the monetary benefit will be used entirely to fund the customer's green pricing. For now, our answer would be yes, because we think that this monetary benefit is firstly need to be utilized for our customers for their green initiatives strategy. But in the long term, due to economies of scale and also our outreach impact, the monetary benefit could be able to be utilized to other initiatives, which includes the impact that such as Cathay Pacific has been doing throughout the years. But now let's take a step back to look how do we actually could get there. So firstly, there are several touch points for this strategy to happen. Firstly, it's using cold call and emails from the CSL sustainability team inside. And second of all would be conferences, because in Canada itself, there are several conferences, especially for the sustainability, such as the Sustainability Conference in Vancouver and several other sustainability conferences that will happen throughout the year. Then, after having several these touch points, we will do the RFPs, the request for proposal for each companies to engage them to be our buyers. Then we need to have several things that we need to consider in advance, which includes firstly the biofuel usage, which is our own internal usage. Then we need to register it to the government to make sure that we are establishing an official business model. Then we will do the sustainability reporting, which is from our side, the CSL, as a Scope 1 emission, and also for the buyers and also customers' Scope 3 emissions. And this sustainability reporting will be enhanced further with our second strategy that Kelly will explain further.
Thank you, Irene. So here's the second strategy about engage. This is something more interesting. So we are having a new platform called CSL Go. So first, why we need a new platform? Why we need a new digital platform? As Irene also mentioned about a lot of like registry, sustainability report, we need to have audit and compliance. Our customers also want to have more sustainability report. But how? How we can track those? How we can make those reports more transparent? How can we comply to the government regulations? How to enhance the operational efficiency? Then here is the CSL Go data platform. So here are a few features in this platform. I will be starting with the customer journey. So imagine you're the customer. In the initial stage that you are having the booking and quotation, you will want to know more about how much carbon emission that you can save during the whole process, whole journey. So this data platform can give you the emission breakdown beforehand when you click onto the booking and quotation. So there, you can have a transparency of the numbers, how much carbon lifted of a vessel, how much of the fuel component, and all of the data points will be stored here. So you can have a scenario analysis beforehand when you click on any bookings. So secondly, when you go to the shipping and transit progress, this platform will give you efficiency alerts. So whether your shipment is being delayed or whether your shipment is going faster, how many carbon emission they are using, you can track it in the in-transit shipments. And they also will give you efficiency alerts to avoid the high congestion ports and also the areas. And also one very important feature that we want to include in the in-transit stage is the real-time matrix on the map, so that you can track that how many ports, how many cargo are stay in that port, and what are the routes that you are going to. So the real-time matrix can provide a real-time data on emission fuel that you save, the carbon emission that you also save, and which this can increase your operational efficiency and have a better reporting. Coming on to the post-shipping stage. So as mentioned before, there are a lot of data, there are a lot of emission saved, how we're going to utilize these data points. So after the post shipment, of course, we have the reminder to you, a notification that how many carbon credits you have saved. For example, there's a visualization in terms of scope 3 emission in this post shipment audit. And secondly, very important, this is the most important thing, is that after all the whole shipment journey, we want to generate an ESG report for each of the shipment, and each ESG report of each shipment journey will be turned into your monthly report, your quarterly report, and also your annual report and your financial report as well. So this is a very important point to keep track of all the emissions that you save, that you use, and it's turned into a better reporting. So again, let me remind for all you guys, so why we need a data platform is because our customers are looking for more transparency in terms of the audit, in terms of compliance. They want to comply more on the regulatory system and government. And so we implement this data platform, which called the CSL Go Sustainability Platform, to comply all the government regulations, and also to have a better reporting in terms of your annual reporting, your regulatory reporting, and also these all the reports can help our customers to also apply and obtain new green certifications, which this can truly make a win-win-win situation, that which Irene also mentioned in the beginning, how our model, and this is the implementation to achieve the win-win-win situation. And now I'm going to pass on to Hazel to talk more about our implementation and the impact overall.
Thank you, Kelly. Now moving on to the implementation, we're going to finish all of our preparation by 2026 and start rolling out our operations by the end of 2026. Now, what are some few quick steps that we can take as soon as possible to implement the Empower and Engage strategy? First, we're going to define the roles and the responsibilities for the Scope 3 offtake team. Next, we're going to define and hire a software development team to do the platform development for CSL Go. And lastly, we're going to sign up for conferences and RFPs to promote our Scope 3 offtake. Other than that, we have also discussed several other risks and mitigations, with the most notable one being double counting of carbon credits during transactions, which we have mitigated by having a sustainability team, which will help us to adhere according to the GHG protocol and also adhere to the rules. Now, moving on to the financials, by implementing our strategies, we will be able to cover the biofuel margin erosion by implementing our strategies. Now, moving on, we are basing this based on the average customer data, which was provided by the case. For an average customers, we have calculated that they're going to have 9.9 metric ton CO2 emission savings from the usage of biofuel, and also an average customer will provide us an annual revenue of 30 million Canadian dollars. Now, after we go through these data, how can we benefit even more from this? Now, by implementing our strategy, especially strategy 1 Empower, we can see that we will earn a profit of around 10 million Canadian dollars from the Scope 3 offtake strategy. Now, through that 10 million Canadian dollars, we will be able to offset the 12% margin erosion from biofuel, which accounts for 3.6 million Canadian dollars. And that leaves us with an incremental profit of 7 million Canadian dollars. Now, other than that, we also have an extra 2 million Canadian dollars for the platform development, which will also be offset by the incremental profit earned from strategy 1. And that is how, with our strategy, Empower and Engage, we will be able to offset the trade-off between sustainability and cost risk with CSL partnered companies. Thank you.
Thank you very much. That is the end of our presentation. I will now like to remind everyone that this is a Q&A period. It will last for 10 minutes, and the timer will start whenever you're ready.
Thank you. You can all sort of relax a little bit. Question. So, and you did a good job of telling me how I make money, but how do I sell this to my clients? Because they're still going to be looking at this and saying, there's a price differential here. They see a price differential, and are we telling them how much money we're making on terms of selling our credits?
I think to jump on that question, and my teammates can support me later on as well, on how the business model works is, so the Scope 3 emission offtake is basically, because CSL has a surplus of Scope 3 emissions, it is a channel in order for them to sell these Scope 3 to the potential buyers, such as like large tech companies, for example. And then and after that transaction, after transferring those credits, those additional money from the sale will be used to offset the green premium that currently has been eating through CSL's margin. Right. So because they were considering to release the 12% margin from their own to their customers by incorporating a green pricing. So instead of transferring this additional 12% to the customers which are price sensitive, such as the agricultural people who need to transfer like a lot of bulk and definitely a lot of metric tons, these profit will be used to offset this 12% green pricing difference. So this is definitely not something you put in the pocket, it's for the best of everyone. So firstly, it's aligned with the vision and mission strategy of CSL in order to ensure that you can continue using these biofuels without cutting your margin, and also protecting your own customers by not charging them premium pricing, and as well having these surplus of Scope 3 emissions to those potential prospective buyers which are increasing in the market. Yeah.
Thank you.
I hope that answers
Yeah,
the
I had a
question.
very similar question you kind of answered. I also wanted to add, did you include, so in your margin profits calculated, did you also include the cost of the marketability for this program? Because there will be costs associated with it. Did you take that into account as well?
Yes, I will gladly take you through that. So for the Strategy 1 Empower, we have considered several costs, which accounts for a total of around 5 million Canadian dollars, and that includes, the first is the annual Scope 3 registration and audit fee, which accounts for $2,500, and next are the conferences which we will promote our services and the Scope 3 offtake to the buyer companies, which will account for $1,300 per conference, and we estimated that we're going to attend around 3 conferences annually, which accounts for $3,900. And lastly, we also have costs for the RFP procedures, which accounts for 5% from the revenue.
Okay. You like the slide?
I do, yeah. I'm not going to ask a question on the slide. Can you summarize in one sentence what your strategy is and what the financial benefit would be to the customers and to us? One sentence.
Sure. To summarize, our solution is providing and suggesting to incorporate a Scope 3 offtake model, business model, through offtake agreements, as well as providing value-add services through CSL Go dashboard platforms for incorporated compliance and assurance, which provides an ultimate impact of less to none green pricing for CSL's customer, and and strategic alignment and sustainability commitment for CSL in the long run.
Very well done.
I think I'd rather look at the slides.
A lot of punctuation there.
Thank you very much.
Thank you. Hope that answers.
Thank you.
You started the presentation by you use the word share risk. In your phrase, how does the customer share risk with CSL? How is the risk being shared by your customers?
So shared risk is something that has been happening currently in the market landscape. So this is referring to the green premium that customers pay. Typically in Canada, it's 5% for some goods and services. So this is what we're referring to as a market trend as a whole. And this is something that CSL wants to kind of avoid according to their internal strategic alignment. So that is why it is part of like the greater macro direction as part of the initial situational analysis.
If you go back to your financial table, the appendix, the one you were on before. Yes,
Yeah.
this one. So could you walk me through the, like conceptually I understand the credits, but what can we sell credits for? And then what's the offset versus the cost of our biofuel? So the first revenue lines there. Could you walk us through that, please?
Yeah, so from the Strategy 1 Empower, we will earn a total revenue of around 15 million Canadian dollars. And that is through, first, we take a look at the average customer data. And from that average customer data, we have calculated that the average annual emission savings from using biofuel was amounting to around 10 million metric tons. And we have done our research, and we estimated that from those 10 million metric tons saved, we will be able to sell 67% of those emissions for our Scope 3 offtake model. Now, we have also done our research, and it is estimated that the price of 1 metric ton sold to the Scope 3 buyers is $14.80. And we just calculated that if we were able to sell all of our emission saving to these customers, we will be able to earn around 100 million Canadian dollars. Now, obviously, in a real situation, we will not be able to sell all of our emissions, and that is why we estimated that we will be able to take 15.6% of the market share based on the market growth, and that amounted to around 15 million Canadian dollars.
Thank you. And a follow-up question. For the platform CSL Go, who do you see as the audience for this platform? Who's actually going to sign in and view this platform?
So for the platform, it will be CSL's current customers. And of course, if there's a new customer coming in, we are wanting to onboard them as well. So the reason that we created this platform is because, first of all, we didn't charge this premium platform more for our customer, but we stay in the same price, but offering this as a value-added services to them. The reason to that is because we also want to promote the green initiative to our customers. That's why this platform is also helping them to have a better sustainability reporting so that they can engage with us coming into this cycle. So this is the overall strategy that we want to promote to our customers.
Just a bit of an add-on. CSL is right now we want to try to brand CSL as a very sustainable company, but the sustainability initiative doesn't stop on us because we want it to be on our customers as well, and that is the reason why we want to introduce this platform to help our customers to track their emissions, and also we want to make sure that we are very transparent by our own, especially having this emission take-off, so that we are very transparent in the industry, especially knowing that this is very crucial, knowing that it's a very widely discussed topic in the world right now.
Just a reminder, we have time for one more question. About a minute left.
Okay, I'm going to ask a question. Does the capacity exist within our company, CSO, to actually go out there and find buyers? Or do we have to bring that talent in?
Happy to take on that question. So there's a lot of case studies actually in the transportation industry that has been going around and actively searching buyers, and there has been like a lot of deals going on. So definitely it is a possible strategy to go out and sign deals with buyers. We did suggest in the implementation timeline that a specialized team may be required in order to check more diligently on the compliance and regulatory changes, but that's for the initial touch points between CSL itself internally and the buyers. So definitely it is a possible strategy, and through these various outreaches through the calls, emails, which is a strategy that's also adopted in aviation industry, as well as a lot of sustainability and Scope 3 conferences. It's always a platform and a method to connect and get these open channels for these RFPs to occur. One example is actually they just signed the Microsoft and Cathay just signed a SAF offtake deal agreement recently, which is in Hong Kong. So a lot of these like airlines industries are actually doing Scope 3 emission trades with various tech companies. So that's one target market you can look for.
Thank you.
Thank you.
Thank you
very much.
Thank you very much. That concludes our presentation and Q&A. Thank you very much, delegates and judges. I would now ask the delegates and the audit member to leave the room so we can start deliberation period. Thank you.
Thank you so much for your time.
Thank you. Thank you.